Hey everybody, hope everyone is doing well and had a good day. This video will be an end of day review for Friday, July 11th, 2025 for the Emini 5-minute chart. And quickly, I want to talk about the weekly chart, the higher time frames, what's happening here. The market is testing the all-time high. If we just zoom out and look back over about a year or so ago, we had this strong spike in channel bull trend, and then from the prior all-time high, the market fell about 1,400 points. That's a significant trend line break, testing the start of the channel. So the bull channel evolved into a trading range. Now the bears are hoping this is a major trend reversal where they break the trend line, test the extreme, and then we reverse into an opposite trend, a bear trend. But the retest was strong, and more likely the market will go more sideways. And by the way, when I say the market's in a trading range, the way I see it is something like this. Spike, pullback, channel. The start of the channel is support in the bottom of the trading range. This channel becomes part of this trading range. Big up, big down, big up. Now we're testing resistance with, looks like 3 legs up. 1, 2, pullback, 3. So if we think about what happened here, it's kind of being reflected on the daily chart too. Bulls who bought up here, anywhere up here, got trapped into a big bear breakout. And now we're getting a retest. But is this rally a vacuum test of resistance? Are there trapped traders who bought up here looking to sell? That's the question. Or will the breakout succeed and we break out into a new bull trend? And what I mean by that being reflected on the daily chart over the past 5 days or so. Strong bull breakout, and this is the GlobeEx chart, the ES extended hours chart. Strong bull breakout, reversal, inside bar, by the close bulls, trapped, disappointed here. The high close becomes resistance, but now we have a micro double top, so up, down, up, but this is a bad sell setup. And the odds are there were buyers below yesterday's low. 4-bar micro channel, bullish environment, bad sell signal. It's a low probability sell. If you sell below the bar, your risk is small. Reward is big relative to the risk. But when that's the case, the probability has to be low. But as far as the high close, probably sellers near yesterday's high as well. Depending on where we open, if we open within yesterday, the range of yesterday, then yesterday's low should act as support. But if we gap down below it, then the expectation is that it acts as resistance, which I'll show in the 5-minute. And we did have a gap down going into the day, so let's briefly look at the GlobeEx chart going into the day. Here's the 15-minute chart. And here's the context going into the day. So yesterday closed around here. Big bear breakout, about a 50% pullback, second leg down in the form of a channel. So the bears have a completed structure, spike, pullback, channel, expectation. Channel evolves into a trading range. And the start of the channel being up here means there's a magnet up here. Most of the time the market breaks out above or below the high or low of the GlobeEx range. So those are good prices to keep in mind as well. But as we go into the day, the market is mostly sideways. So generally speaking, looking at the past 20 or so bars here on the 15-minute GlobeEx chart. Expectation probability for both sides is about 50-50. But because the bears have a completed structure, 1, pullback, 2, and this channel should evolve into a trading range most of the time, my expectation going into the day is that rather than continuing lower, we will actually rally and test somewhere higher. But if we do get up here, probably resistance and the upside will be limited. For the 5-minute today, looking at the GlobeEx chart, that clears the lack of information with the gap down. And with the gap down, we had a gap down and follow through, bars 1, 2, and 3, bear bars. Good for the bears. The only problem with this 3-bar micro channel, bars 1 through 3, and again, if we look at the GlobeEx session 5-minute chart, here's the context. It paints a different picture. So here's that trading range. I talked about the 20-bar trading range on the 15-minute. There's more bars here on the 5-minute. And maybe it's an expanding triangle. We have a high, higher high, higher high, low, lower low, maybe going for a lower low. But bars 1 through 3, what leg is bars 1 through 3? Could it be leg 2? Could it be leg 3? It's probably leg 2 or leg 3. You could count it like this, leg 1, complex 2-legged pullback, leg 2, or other traders might see it as 1, 2, 3. When you have a breakout of a double bottom like this, functionally it's a wedge. So even though it doesn't have a wedge shape, a breakout below a double bottom functions like a wedge. And then what's the context? Are we breaking far below many bars to the left, or are we testing an open gap in a trading range? Bad buy signal bar, low in the trading range, bar 3 testing a bad stop order signal bar, which usually acts as support. Strong bull breakout. Bulls have their second leg on the rally on bar 1, but we're testing the bottom of that rally, which is support. So because it's a late leg for the bears structurally, and we're at the bottom of a trading range, it might be more likely that the downside is limited, and rather than selling here, it might be better to look to buy. Also, when bar 1, or let me rephrase that, most of the time, bar 1 does not remain the high or the low of the day. And because of that, because bar 1 is the high of the day at this point, it's unlikely to remain so. About an 80% chance we test at least one tick above the high of bar 1. And usually when there's a gap like this, I will trade the 5-minute looking at the GlobeEx session just because it fills in that gap and gives me more information. And if this is functionally a wedge, what's the expectation here? Some traders might call it a wedge double bottom, 1, 2, 3, 3 pushes down, double bottom here. Expectation, you have a couple of legs sideways to up. So rather than sell down here, like I said, this is the buy zone of the trading range. In the trading range, you want to look to buy low and sell high. I don't have time for a bar by bar review today, so I'm going to keep it short and scroll along, but we can see the reaction to this support. The wedge double bottom, big outside bar 4, leg 1 for the bulls, second leg up likely. Good context structurally. The signal is strong. Outside bars are context dependent. You can argue it's an outside bar, it's an expanding triangle, but it also trapped traders below bar 3. Any bear who sold below bar 3 got trapped on bar 4 in a big way. And that creates a sense of urgency for the bears to give up, for bears to buy back shorts. because we have a micro gap from the bar 3 high to the bar 5 low, that's also going to decrease the chance of a deep pullback or increase the chance of a more shallow pullback. Whenever there's a micro gap, it's a sign that there are trapped traders. Even if a trader did not sell below 3, they sold above bar 3. If you imagine selling above bar 3, which it's a reasonable thing to do, 3-bar micro channel, you sell above the last strong bear bar, and you get bar 4 as your entry bar, you're trapped into a losing position. You get a pause bar on 5, which did not retest your entry price. And you got to be thinking a couple of things. One is that the market went against you in a big way and got minimum follow through. This is a bad sell signal. There's probably buyers below. But also, if you're going to hold short, where's your stop? If you're risking to the top of the bear leg, there's your entry. 1 times your initial risk is down here. At what point do you give up on the premise of the trade? What invalidates your premise? If you get a reversal and follow through against your position, is that enough to bail out of the trade? Do you buy back your short immediately? Do you scale in and try to exit at break even on the entire trade? Traders who, let's say their stop is here, first entry is here, and they scale in at the midpoint between their stop and their initial entry, so they sell more at the purple line. Bar 5 actually would test the average entry price. So if you're quick, you can actually avoid a loss there if you sold and scaled in higher here. But in this case, the bulls got more follow through. Big, small, big. Strong bull breakout, 3-bar micro channel, probably buyers below, second leg up, likely. With a big, small, big, this kind of structure for the signal, usually the market tests the high of that pause bar and it becomes support. Bar 7, you can see we tested the high of bar 5, but did not quite get there. Bad sell signal, bar 8. When you have a 5-bar micro channel, you could say it's a double top with bar 1 and bar 8. It's another one of those trades where risk relatively small compared to the reward. Whenever you have a fantastic risk to reward ratio, the probability is low. So if you're selling below 8, you're accepting that you're going to lose that trade most of the time. And if you sell below 8, you really cannot scalp out of the trade. You have to hold for that 2R target or even more, because that makes up for the low probability. And you can see what happened. The market fell below bar 8 and reversed up, did the higher probability thing, ran the stops above 8. Same thing happened on bar 12. Strong bull breakout, 3-bar micro channel. 12, a doji, weak, stop order sell. If you're selling it, stop above 12, you're taking a low probability trade. Whenever there's a low probability sell, there's a high probability buy. So low probability stop order sell below 12, high probability limit order buy below 12. Trader can buy below 12 and exit above bar 12 or at the high of bar 12. And that's what happened on 13, 14. 13 outside up immediately, and then profit taking on 14. 14 is a better sell because it's a second entry, micro double top, up, down, up, down. It's a bear bar closing on its low, far above the moving average, and it might be 3 pushes up. 1, pause, 2, pause, 3, then tight trading range, breakout mode. So reasonable to exit, or let me rephrase that. Always in bulls, it's reasonable to exit longs below bar 14. Bears can sell below 14 with a stop order. 15, the entry bar, actually a good entry bar for the stop order sell below 14. Why? Because look at the overlap between 15 and 14. probably 95% of bar 15 is breaking out below 14. If a trader bought below 14, they're trapped on 15. And what 15 is, on a smaller time frame, a single bar, it's a breakout pullback. So 15, now it's a bad high 2. You could say it's a high 1, 13, high 2, 15. But reversal and follow through after consecutive buy climaxes. Again, GlobeEx, look to the left. And we're at the top of a trading range. So 15, probably a sell to close bar. And at least briefly, always in short. Probability increases for the bears as they get 3 and 4 bars in their direction. Now we have a 4-bar micro channel, probably sellers above the prior bar, the prior bear bar. The first reversal should be minor, but 18 remained an inside bar, 18, 19, II. Traders trying to sell above the last bear bar never got filled. There's a sense of urgency as bar 19 and 20 form, and then a give up bar, 21, bears get their second leg, 1, pullback, 2. As far as symmetry goes, let's see. From the high of the first leg to the low of the first leg to the high of the pullback, it's very close to a leg 1, leg 2, measured move down. Bar 21 here, I want to switch over to the day only session because this reminded me of another day up till here. This area, 20, 21. Tight bull channel, rally to the moving average, many bars, price and time control. The bulls should get a second leg up here. And then the bears get a 2-legged pullback. So trendline break, strong enough for a second leg. We pause. The bears get their second leg. But now we're testing support. We've got the 50% pullback level. We've got that high of bar 5, the pause bar, open gap here, and 21's acceleration. But first of all, what's the context? Is the market in a trend or is it in a trading range? Big up, big down. Neither side clearly in control. The market's in a trading range. What leg is bar 21? It's leg 2. Leg 1, pullback. Leg 2 with acceleration. This could possibly be a second leg trap. And what this reminded me of, it's kind of random, but it reminds me of November 20th, 2024, over here, where it's kind of similar. We have this rally to the moving average. It's a trendline break. First of all, big up, big down. We're at the bottom of trading range, price control and time control. But to the moving average, the bears get 2 legs down, 1 pullback, 2. And 24, strong looking bar, but possible second leg trap. Testing support. You've got the 50% pullback level. You've got a bad stop order, bar 10. So there's support, layers of support down here. Anyway, I just thought that was interesting. The bulls should get a second leg. The bears have 2 legs, second leg trap in support, in a layer of support in a trading range. Just thought it was interesting that they're similar. So when you see 22, probably better to exit shorts and look to go long. But 22, if you're buying above 22, technically this is a micro channel all the way from bar 14 to 21 or 22. So better to wait for higher probability if you wait for a second reversal. So reversal and follow through 22, 23, pullback, and then 24, the second reversal. First reversal 22, second reversal 24. There's a couple things here. Some traders might see this as a wedge double bottom. 3 pushes down, 13, 17, 21. Double bottom with 9, slightly lower low, or double bottom with 6, slightly higher low. But also what's happening here, on a smaller time frame, the market was in a bear channel from bars 14 through 21. And 21 being acceleration, it's break below a bear channel line. And we know that when the market breaks out or attempts to break out of a channel line, usually it reverses within 5 bars and tests the trend line. So we have bear breakout of a channel line. The expectation is a reversal within 5 bars and a test of the trend line, and then the reversal and follow through is big enough for a second leg. It broke the trend line, especially this trend line, 19 through 21. And I actually want to show it on maybe the 1 minute chart, because it's basically 24 is basically a higher low major trend reversal on a smaller time frame. So if we look at 11:30 on the 1 minute chart, that's what we'll see. We'll see a bear trend, a trend line break, retest, and then a reversal up. Here's the bear channel. Here's the breakout below the channel line. Different computers draw it different ways, but let's say that's a best fit. Breakout below, reversal, strong breakout, breaking this trend line, retest, testing the stop order, price here, expectation. Both should get at least a small second leg, but they're hoping for a higher low major trend reversal here from a bear trend into a bull trend, which is basically what we got. I always think it's interesting to see major trend reversals like that unfolding on the smaller time frames. But the bull trend is really just 3 or 4 bars, so realistically, it's a scalp. It's a second leg up from the rally up to bar 13 or 14. So bull breakout, 2-legged pullback, 50% pullback. Then this bear channel gets a trend line break, retest, second entry long, 24, reasonable stop order buy for a scalp, and a test of the highs, which maybe got a swing trade out of it, and you got twice your initial risk. So 24 is a good scalp and a good swing. Big down, big up. The market's in a trading range. However, we do have high, higher high, higher high, and a low, higher low, and higher low. So the bulls will argue the market's in a bull channel. So bulls will keep buying pullbacks and trailing a stop below major higher lows. 27, arguably a breakout to a new major high, which makes 22 a major higher low. So bulls can buy pretty much for any reason. Even if they buy the high tick of 27, use the appropriate stop, scale in lower, they make money. But 28, bear bar closing near its low, double top, probably some sort of trading range day with the two-sided trading we've had, big down, big up, big down, big up. So 28, if you're long, reasonable to exit below 28. Low probability sell below 28. It's against a 4-bar micro channel, which is strong, meaning the signal is strong. Uniform size bars, open gaps, bars closing on their highs above the prior bar's highs. Things are going for the bulls. The problem is the context. It might be leg 2 or even 1, 2, 3 at the top of a trading range. So not ideal to be buying up here. But if it is a trading range or a bull channel, bulls will buy pullbacks. So bear bar closing on its low, reversal and follow through, or breakout follow through. Second leg down, likely, which the bears get their minimum. There's your leg 1, pullback, leg 2. 2 legs down, testing support, back to that higher low major trend reversal. We're also testing the bull trend line, which is simply a parallel of this channel line. So a couple of support levels here, plus we're testing the low of yesterday. We broke below yesterday's low, but reversed up strongly above it, and then it became support. Tried to break below, reversed up, trying to break below again, and reversed up again. So this is kind of also another higher low major trend reversal, where this is a bear channel, bear trend line break, retest, higher low, and then there's a buy above bar 40 for a test of the highs. In this case, we had a test of the high close and a pullback before the highs were tested later on. Tight trading range, top of a trading range, better to either be flat or short. So bears can sell, bulls can exit below a bear bar, 47 or 49. 50, 51, bear breakout and follow through, 3-bar micro channel crossing the EMA, but where are we testing? The market is testing an open gap, which is support. And if the bears get momentum but then bad follow through, we're testing support. Again, this might be on the bull trend line. The bears really need momentum here. If you're selling here, you're selling 50, 51. 51's a warning that, yeah, there were sellers here for scalp, but where did the sellers go? Why didn't 51 look like bar 50, closing on its low down here? So 51's a warning that it's a couple of legs down, testing support, open gap, the high of bar 40, and the bull trend line. So for selling here, the problem, your risk, if your risk is this swing high and you're selling the close 50, 1 times your initial risk is down here, and then 51 pauses. And are you 60% sure the market's going down here before to your stop? And especially when you get bar 52, probably better to exit if you're short above 52. And bulls can buy to stop order buy above 52. A couple legs down to the support areas I mentioned. And the channel continued. The channel line, as we get more information, it evolves. Maybe that's the channel line. We test it here, find resistance. We test it again, find a resistance. So the upside looks like it's limited. The market's getting squeezed. The trend line and the channel line are getting closer together. And eventually one side will give up. But because it's a bull channel, you expect the bear breakout 75% of the time. Because the bulls are exhausted. They've had several legs up. And they're hardly testing the channel line. They're not breaking far above the channel line. So you start to get 2, 3 consecutive bear bars turning down from the channel line after many legs up on a trading range day. And the expectation is the channel evolves into a trading range where the market could test all the way back down here. If you're long for any reason, you just get out below a bear bar 64 or consecutive bars 65, 66, and there's the give bar 67 and 68, testing that low of yesterday once again, also testing this support level, bar 32, 33 low, and this bear breakout 64 through 68. Significant price movement, time control and price control. The bears should get a second leg down, but when the market's down here, it's at support, it's at the bottom of a trading range. While the bears should get a second leg, it's kind of similar to selling here. The bears need sustained momentum, and if they don't get it, then suddenly they are selling low in the range, and they need that momentum for the probability. So if you're selling here, you start to get these bounces in 68, reverses up. You're selling near the bottom of a trading range with a big stop and a big reward. The trader's equation is not good. And what happens? The market reverses and vacuums up to an area of resistance where traders are willing to sell. Where was there a reasonable sell? Or where are trapped traders? Here's a 4, 5-bar micro channel. Bulls will buy below the last strong bull bar, 63. And if they did, they got trapped on the breakout. So on the reversal up, there's probably resistance at that 63 low. And we can see that reaction on 72. Bulls get a micro channel, but the reaction at 72, we found resistance, and then we have a second reversal below 74, higher probability to wait for the bear breakout 75, and then traders sold a pullback, testing this tight trading range, and the bears get their second leg down. 1, deep pullback, 2. Back to the bottom of the range, 2 legs down, probably support in this area. But the buying pressure here, not very good, especially on the way down here. Good for the bulls that there's no micro gap, but the only bull bar 76, 79, a very small doji. Alright, that's going to be it for today's review. Thanks everybody, as always, for watching and listening, and I hope everyone has a great weekend.